it's your last chance to take home an Apple gadget, get in touch with our property specialist to know how to get an Apple gadget from Ortigas Land. Okay, awesome morning, everyone. Welcome to today's webinar entitled Opportunities Matter, Know the Importance of Investing Amidst the Pandemic, brought to you by Ortigas Land. I am Paulina Aguilar, and I will be your host for this morning. For questions throughout the discussion, you may send them via the comment section on our Facebook page at OrtigasPH or via the Q&A box here in Zoom, and we'll try to answer as many as we can. The reason why we're doing this webinar today is because we at Ortigas Land want to guide you in your financial matters and investment decisions. And we know that our speaker this morning can help you understand why it is still important to invest amidst the pandemic that we are facing right now. So he is the president and CEO of Ramper Financial, a dynamic player in the financial services specializing in investments and one of the biggest distributors of mutual funds in the Philippines. He is the lead independent director of two listed companies, Globe Telecom and Ayala Land Logistics Holdings Corporation, and an independent director of another two listed firms, the National Reinsurance Corporation of the Philippines and Ayala Land Inc. He is also a director of Esquire Financing Inc., the Colinion Group, Techno Marine Philippines, Seven Tall Trees Events Company Inc., and Mobile Group Inc. He is a member of Brother Bo Sanchez Mastermind Group and is cited by many as one of the best leadership, business strategy, investments, marketing, and sales speakers in the country. He is the author of two books, Trailblazing Success and Firing on All Cylinders, both certified national bestseller. He served as the president and CEO of Philam Life, one of the country's most trusted financial services conglomerates, and was chairman of its affiliates and subsidiaries. Prior to his position at Philam Life and the AIE Group, he was senior vice president and chief marketing and sales officer of Ayala Land Inc., wherein he held several concurrent positions, including president of Ayala Land International Sales and chairman of Ayala Land Sales Inc. Let us all welcome Mr. Rex Mendoza.
Hi, thank you so much, Paulina. Thank you for having us, making us a part of your weekend. It's going to be an exciting talk. It's going to focus on many things, and obviously it's going to take note of this pandemic that's in front of us, causing a lot of pain, difficulty, and anxiety for many, but can actually become a major opportunity for others. So let me share my slides here. In this particular talk, sorry, having problems there. Okay, in the last like 3.5 months, there's been a lot of changes in the way we live life. And that has really caused a lot of anxiety for people looking at their investments, looking at what they have set aside. There are people who are close to retirement. There are people that are accumulating, different stages in our financial journeys. And true enough, I mean, COVID has really changed a lot of these things, have really changed the way we are on these pathways. And it's not only just a medical concern, it becomes a future concern for everyone, whether you're not going to be affected by it health-wise. So in this short presentation, let me be able to give you a glimpse of how the pandemic has actually affected major investment instruments that we know and are part of, generally stocks, fixed income instruments, and of course, property. And in the end, try to make a bit of projections and look at the future and how it's going to impact us, impact what we have, and impact our investment portfolios. And again, it all goes back to a like 180-degree turn and gets to us personally. What do we need to do? Would there be any adjustment or refinement in the way we have to view things? And how does this really get analyzed and evaluated if we're not going to look at simply the present, but also the future, which is very important as a perspective for investors. And then lastly, we have to take note of what opportunities are really out there, what instruments, what investments can we put in this portfolio of ours to make it resilient and to make us protected and positioned for growth at the same time in the future. So if you're going to be looking at, sorry. So am I sharing the slides correctly? Is it coming out? Okay. In this slide, you're going to see the Philippine Stock Exchange Index. Sorry, I'm using it as a as a metaphor. It's actually a forward indicator of the way people, investors in general, think about the economy and the country. Okay. I am not so sure if you're seeing the slides. Let me. We're having some technical difficulties here. Let me. So sorry for this. Okay. So sorry for that, ladies and gentlemen. Sometimes things happen. Anyway, as I've mentioned, this is the forward indicator of the way people and investors in general feel about our economy. So if you're going to be looking what has transpired, it's the biggest drop and the fastest one ever in recent times. And when I say that, it's actually 3 decades. The drop that happened in March erased 41% of value in the Philippine Stock Exchange Index. Right after that, within the next few months, we recovered by 37%. It was a quick recovery of 37%, but that doesn't lead us to like equating it to the start of the year. We're still down maybe about 21% by now. And if we're going to be looking at the very top in 2018, you're going to see that we're still below 32%. So this kind of rattles many people. I mean, it's almost like an erasure of a huge part of their wealth, a huge part of their net worth. And the question now becomes, where are we headed? Is this a consolidation that can be there for a long period, or is it something that we can expect to simmer down and maybe stabilize in the months to come? So when you look at stocks, our friends from ETR Asset Management have said this very, very aptly. There are weeks when decades happen, and there are decades where nothing happens. As I've said, fastest drop ever. Even if you're looking at it from the United States point of view, their bear markets, it is even comparable to the 1930s. So, and why did that happen? It's because everyone concentrated. Governments concentrated on containing the virus. No one actually thought about, many people didn't really think about the economy. The economy took a back seat because governments focused on containing the virus. And people who did not do that, governments who did not do that, were spooked because eventually they had to lead to a bit of closures because their hospitals have been filled up. So what happened? Revenue streams got cut. So it's not like the crisis before where we're hit financially and big business is actually hit. This time it's really very different. Ground zero, the main economy. People were not exchanging, people were not trading, people were not buying. I mean, how many of you purchased a car recently? Probably very few, if there are some. Clothes, shoes. So essentially, the overall economy has been put to a grinding halt. And that's the reason why, companies also pulled back. Capital expenditures were pulled back, and the expansions are not going to be happening. Because of that, consumer confidence has actually dipped. And in general, consumption has actually died. So if you're going to be looking at it, this ECQ, GCQ puts the Philippine economy on a stop, and the simulation suggests that we're going to be -2 for the remainder of the year. for this 2020, for this year 2020. However, as I say that, there are new studies right now that are already putting us at -3 or 4. So it's actually deteriorating from earlier projections because things are getting longer. I think people are waiting for the government to maybe implement EGCQ, but there is enough challenge with that because of, I think, the curve not being flattened. So is the recovery still going to be a V? There might be faint hopes for a V, but generally, I think people are, really focusing on a U and maybe even a longer U. So if you're going to be looking at this, it's not just the Philippines, it's actually globally. And even big countries like the US and countries in Europe are really, really hard hit. I mean, more direly hit than us. When this was done in April, if you're going to look at it, we were still hoping for a 0.6 growth for the year. And as I've said, the latest ones put us at about 3 to 3.5 on the negative. And why so? If you're going to be looking at the earnings of the companies that make up the Philippine Stock Exchange Index, the reports for the first quarter are not exactly that good. 93% of those who have reported as of this, the preparation of this presentation, all of them on a weighted average scale decreased their earnings by 14.15%. And remember, this is just the first quarter. How much of the first quarter were we in an ECQ or a lockdown or quarantine protocols? 15 days. It's like half a month over 3 months. Can you imagine how the second quarter will be? The second quarter will be almost like 3 out of 3 months were within quarantine protocols. And obviously the expectation is that while some companies would have adjusted a bit, the slide in income would still be major. So people are not expecting that to turn around so fast. So if you're going to be looking at earnings per share movements, the biggest hit would be gaming and leisure. Okay, there's also a big negative for industrials and power and utilities. However, the impact on the PSE is very different because of the weighting. What will drag the PSE will be property, banks, and conglomerates because they're heavier weighted within the index. So while we are in these quarantine protocols, while people are scared to go out, even as we lift them, I mean, it's not going to be like people are going to go out of the gates and buying and consuming. There would be a bit of wariness. There would be a bit of a scare. So people are now looking at a real normalization close to Christmas, and most probably the brisk exchanges happen afterwards. So if you're going to be looking at expectations, this is the average viewpoint of many fund managers. The real baseline will be 6,500 for the index. The downside, which would be the pessimistic view, will be 5,600. This would be numbers by the end of the year. And the optimistic side, just in case, vaccine comes out very, fast, manufactured and distributed, we can probably hit an 8,400. Now, people are going to say, oh no, Rex, vaccines are not discovered that fast. They cannot be manufactured that fast. And if ever they do, I mean, when will they hit Philippine shores? I agree. Fund managers will not actually disagree with that. However, let me tell you, as I've said, stocks, prices in the market is a forward indicator. So what you see in terms of pricing will be the way people think it will be next year. Not exactly this year, but sometime in the future, maybe next year or even the following year, even 2022. So if people are looking at the future with a bit more optimism, that gets factored into the price today. So the recovery in prices here, the recovery of investments happen faster than probably the actual recovery of the economy. It's always a forward indicator. However, there's a different story on the fixed income side. And I think we all know the movement of interest rates is one of the tools of government in stimulating economies. When governments lower interest rates, the hope is for business to pick up the interest rates, expand their businesses, and move ahead. Because that's a plus for business. That's a plus for people who are actually doing the production. However, that can be a negative for people who are, investing in fixed income. Like, for example, our retirees, their time deposits, they're dependent on the interest of those placements for their upkeep, for their lifestyles. Those numbers will get lower because of what's happening now. Can you imagine? After dropping the guiding rate or the policy rate by 125 basis points, we dropped it by another 50 basis points this week. So the total drop is now 175. The guiding rate is now 2.25, and the reserve requirement has been lowered by 200 basis points. These are policy rates and guiding rates that would have been lowered by 25 bips at a time. But you see the way the government is acting. It's acting with compellingness and conviction. 50, 200, those are the numbers they're doing now. And that's the reason why I think people have, to realize that the stimulus will really be able to help. I'm not going to say 100% bridge everything, but it will really help because it is necessary. It is going to be necessary. And whether, there's a question of how we can afford it, whether we need to borrow for it, I think it's going to be inevitable. It has to be done. In fact, the quantitative easing now is done in such a way that government's the one participating in the bond market. And the tenors, because the rates have gone down, the tenors have actually been stretched. So for those people out there, our friends who are so dependent on interest, people who are living on interest, you might want to be able to change that portfolio because there can be a problem here for your future. In Japan, people were thinking it will never happen, zero interest rates. It did happen. In the US, after Japan did that, the US people said it won't happen. It happened in the US as well. They're at zero interest rates right now. So for the Philippines, we're at 2.25. Can it happen here? Let me just tell you, the 2.25 came from what? 7 or 8. It was even 18% for our, for our forefathers, for our the generation before us. It can be very different from the generation that follows. This concept of low interest rates might be there for quite a while. And let me tell you why that can be supported. Because, see, the risk position of the Philippines is actually panned out. There was a time when investors all over the world, the risk, they got out of emerging markets. So if you're going to be looking at our bonds, the spread rose from the average 200 basis points to over 400 basis points. In fact, 420 basis points. Now it's about 250, 260. And that's the reason why it has gone down to the average. And I would be expecting interest rates in, moving into the next few quarters, continuously going down, which hampers, again, the interest rate earners that are out there. How about real estate? People talked about a crash. People are talking about a slowdown, or will prices hold? Again, when we say these things, it's always going to be specific. It's not going to help if you generalize. Because when we say crash, it can in certain pockets of the market. When you say slow down, it can in certain pockets of the market. But there are other pockets that can hold. There are other, segments that can actually hold water. We can all be affected, but more, areas, in some areas, there would be more impact than others. So what's the expectation for property? There would be a distressed secondary market. Because the secondary market will be held, the properties will be held by people in general who might be hit personally by this pandemic. They can be, stressed in terms of liquidity, and they would probably need money to fend for themselves if they're not going to be having jobs, if they're not going to be having a kitty to draw from. So if you're going to be looking at it, it's a distressed secondary market. And it will be coming from the low income segments of the economy. This will be coming from suburban or subprime locations as well. Because it's very clear that the high-end market, the upscale and luxury markets, they will be, you know, projected to hold because they will be held by more stronger investors. They're stronger investors. They have the liquidity. In fact, some of them are even earning more now than before COVID. So if you're going to be looking at the distressed secondary market, a large portion of that will be focused on the lower end. However, on the primary side, this will not be a 1997. And why am I saying that? Because the bigger distributors of property, the bigger developers of property are now stronger than they've ever been. You know, they have very strong balance sheets. They can complete their projects without having to do fire sales. And when that happens, you know, there would be probably less offered into the market. They will stop production. There would be less supply, but they will be holding on to certain margins. And that's the reason why the real drop can be on secondary, not on primary. And the developers who are on the primary market, they can hold back. They will not be able to get to that same level of 1997 where they became practitioners of what we call deep discounting. Okay, it's very, very different from before. In fact, I'd want to be able to stress this out. There's been a wrong notion with regard to the office market. People are saying, oh, no one will be going to the offices now. People are working from home. Not really the situation in the Philippines. Many of the companies, including my own, we realize how it's not that effective to do work from home. We just do it because we are required to. We just do it because, you know, we're also concerned for our people. But if it's already safe, working from home might not be an option for many Filipinos. First of all, we have very cramped residences. If everyone, mom, dad, all the children will be in the house, will that be a conducive place to work? Also, because of the lack of supervision that's going to be in there. Okay, the temptation of the bed being closer to where you have your table or the refrigerator in the kitchen also being close to where you are is also going to be an issue. So there can be, you know, a lot of factors that will drive people back to their offices. And this is a big one, subpar internet quality and speed. Isn't that real? You know, I'm in the office. Usually I do these webinars from the house. I'm in the office today. You know why? Because there's no internet in the whole of Magallanes village. All of a sudden, the lines just got cut for the entire village. So I had to go to the office to do this. So that's the reason why it's not that predictable. And offices will still be in demand moving forward. It's still a basic, you know, silver lining, as I can say. The per capita requirements can even increase because we don't have to have distances. You know, gone were the days that we're going to be having cramped offices now. We will learn from this virus. We will see that there would be an advantage of having spaces between us. So, which means if people were okay with 100 square meter office before, they will probably need 150 square meters today. So it's going to be like that. So what are the challenges moving forward? As we see, these are not yet resolved. These are still on the negative. Our economic pillars at risk. There are three: BPOs, OFW remittances, and tourism. Two out of the three very obviously are going to be challenged. Unlike past crises, this will hit the micro, small, and medium-scale enterprises. This will not hit big companies only. And that's the reason why, as I've been saying earlier, the ground level is going to be challenged. There would be a continuous issue regarding consumer confidence, and obviously consumption might not go back to previous levels anytime soon. However, you know, I flip that. There are advantages here. There are advantages. If you're going to be looking at the crisis of 2008 and 1997, there were two big things that worry a lot of us. Number one, interest rates. Number two, exchange rate. Today, no one even watches the exchange rate. It's almost like it's even strengthening. The peso is even strengthening against the dollar, while that was an issue in 2008 and 1997. And obviously, interest rates at that time shot up, and that's the reason why people dumped their property. However, today, mortgage rates are poised to go down, in which case people are going to be tempted and lured into buying property because you can buy property at a lower level of commitment. And after this pandemic is over in 3 to 5 years, you can have ownership of great properties with very little commitment during this next 2 to 3 years. So people are going to pounce on that. That is something that can be on the other side. Also, the fact that there is low leverage. We're hovering at around 2 to 3%. In 1997, the non-performing loan ratio was over 10%. Even if we double, our non-performing loan ratio today will be at around 6 or 6 plus, which is way, way far from the 10 we experienced before. And I've mentioned this many, many times. Our demographic variable remains to be the same. We're still within the sweet spot. Over 100 million Filipinos, average age of 23 to 24, working, being able to contribute. Yes, unemployment is a problem now, but that demographic variable is going to be a blessing moving forward. We're not going to have that before. Today we have it. Many countries don't have that either. They are small in terms of demographics. They're old in terms of their age brackets, and they can be a problem, not only for COVID, there are risks for COVID, but they can also be problems moving forward in buttering up and changing that economy. Again, the government stimulus package will help, and obviously the businesses and the way they're adjusting in terms of the supply side cuts will also be a positive. So, which leads me to that very important question. Is it a good time to invest, or should we wait? I go back to a statement I've done so many times. You know, we never control the weather. We're the captains of our ship. We control our ship. So the weather will always be that weather. We have to be able to navigate effectively no matter what the weather is. In fact, volatility can be a friend if we know what we're doing. So if you're going to be looking at the considerations for making investments, what are the main considerations? It's not what's happening out there. It is going to be about you, your goal, your portfolio, your time horizon, and your risk appetite. If you're hard up today, you're strapped liquidity-wise, that's a problem. That would be your problem because you did not do strategic investing before this pandemic. And it puts you in a negative position so you cannot maneuver today. However, if you've done strategic investing very responsibly, even before the pandemic, then you're in a position today to take advantage and look at things with opportunistic mindsets. That becomes very, very different. So what is strategic investing? Let's define it. It's an active, continuous discipline where investor decisions are based on goals, risk tolerance, and future needs for funds or capital. Can you imagine? There is nothing here that talks about the environment. There's nothing here that talks about, the business situation, the crisis, nothing. In fact, when you're in strategic investing, you actually want to remove and lessen the effects of unwarranted negative risk on the long-term return or the long-term results of our financial future. See, you even take the environment out. In fact, if you're doing that, if you're always looking at the current, you're not into strategic investing. That's what it tells you. You are what you call into tactical investing. And when you're in tactical investing, you're going to be very short-term minded. And that's not going to be very, very healthy for many, retail investors. For many of us who are not exactly fund managers, if we don't do that for a living, what we need to do is to engage ourselves into financial planning. It's the process of achieving one's life goals to the proper management of one's finances. So the focus here is not going to be on the management of the finances. The focus will be on the goals themselves. What's more important, the goals or the management of finances? What are you doing this for? It's for the fulfillment of goals. In fact, fund managers who have that as a job have an objective of creating value for the people entrusting their hard-earned savings on them for the fulfillment of those people's financial dreams. So let us not think that we're fund managers within this pandemic. I see a lot of people gambling. I see a lot of people investing in stocks that have gone, I'm not kidding. Yesterday, a stock went up 2,000%. 2,000% from 10 pesos to 240 pesos. Can you imagine that? I mean, how would you expect that to happen? Because people don't even know, that company that they're buying or selling, the bottom line, the net profit is 62 million with a valuation of over what? Over 10 billion. No one's looking at the fundamentals right now. People are trying to gamble. That's going to be a problem if you're going to be looking at your long-term prosperity track. Wealth management is all about goals. And goals-based asset allocation will be very, very important. You take out negative behavioral biases, you focus not on optimizing returns, but the attainment of goals, which tells you we don't have to run after high yields because high yields can sometimes put you within excessive risks. What we need to do is focus on what needs to be done and manage not the economy, but ourselves. Manage ourselves so that we can put the right things. And I'm putting up here the rule of thumb. It's just a rule of thumb. Many people can, do a plus or minus on certain percentages. That will help. But the important thing is this, that we deal with this with enough discipline, because what you can control is not the environment. What you control is yourself. And if you can control yourself, the way you spend, the way you earn, this will be a great opportunity for you. So property investing can be a massive input within an asset allocation program. And why is this so? Because real property can enhance those asset portfolios. Number one, we know that through property, we can get cash flows and passive income through the lease rental. But there's another plus from property. Unlike deposits, I sometimes call them certificates of depreciation, not certificates of deposit, certificate of depreciation. Why? Because the value of the money that's there, while it pays you interest, loses or goes down in value. In property, while you can probably rent the property and get lease income, the property by itself also appreciates through natural appreciation, people getting more, people getting bigger into businesses, but land and property not being able to follow suit in terms of supply, and forced appreciation. When people put value into their property, enhance it with interior decoration, technology, and all that stuff so that it increases in value. On top of that, property is tangible security. In times of runaway inflation, finite inventory and replacement costs are natural inputs that will make you hang on to something that can weather high inflation environments. So we need that. Plus tax benefits. For you who know how to use this accounting terminology, you can put real estate and expenses in real estate to lower your taxable income. Also, how can we even enhance the results from property that's already there? We can even enhance it through the use of leverage. By not paying 100%, by using these deals that property companies are coming up with, you're actually lowering the commitment. So your actual return will not be based on the cost of the property. It will be based on what you have given so far. So when you say that, you now have to compute for a very, very different income stream. It will now be based only on what you have given, which means instead of buying one, you buy two. You lower the level of commitment through a payment scheme that's effectively or maybe creatively made. And instead of earning on one property, you actually earn on two, which puts your earning percentage into a multiple. Okay? Access to funding and refinancing, because rates are going to go down. We can refinance some of our properties, take the equity that we have there, and maybe even use this for future purchases. Legacy for generations. I've always talked to fund managers and my friends who are there. They always say, if I give my children, securities, if I give my children liquid assets, in less than a generation, that can be all gone. But if I give my children real estate, that can be held for generations to come. And this is the reason why, the wealthiest of the wealthiest in Florence, Italy, are still the wealthiest today, because they hold the prime properties of that specific area. And of course, the convenience and handling. But again, let me remind everyone, execution is the most important determinant in optimization. Are you going to execute? Are you going to make changes? And that's the reason why I lead us to probably the options that we have here today. Ortigas Land is coming up with this webinar, inviting all of you to look at probable opportunities that they have for you. There are brokers and sellers out there who have invited you to attend this. Maybe it takes a bit of a perspective, an optimistic perspective, to look at opportunities that are there. Knowing Ortigas Land and the way their track record is all about, they've come up with names that are etched in our history, names that will always be hallmarks of growth centers in the country. You know, Green Hills, Valle Verde, Green Meadows, Tiendesitas, Capitol Commons, all of these names are household names today. You know that they're growth centers. You know that asset values in these areas are going to be continuously going up. And why do I say that? Why do I say that for Ortigas Center and places like Capitol Commons, they will always go up? Unlike developed countries where they focus on location. In the Philippines, it's not all about location. Sometimes the right location can be a bad location in a few years' time, in a few decades, because of problems within that area. So you have to have a combination of a good location and developer commitment. How did that developer master plan that area? How did that developer put all the infrastructure that would be necessary in that area? And more importantly, how is that developer consistently supporting that area? See, if you're going to be looking at the best growth centers in this country, Makati, BGC, Ortigas, all of these are supported by certain developers. And then these are reputable developers, and they will not allow, decay to happen. And you know that in many other places in the Philippines, there is urban decay, and they need, some changes. But for many of them, because there is no support, and then only local government units are manning them, there can be a problem because capital is required. Capital is required when you look at developer commitment. And this is the reason why I also want to differentiate areas of growth which will have infrastructure. And we're not talking about infrastructure. It would be strategic infrastructure. You know, the connection of Ortigas Center to BGC, MRT4, and the subway. You know, Ortigas will not only have one, but two stations within that subway, which essentially connects it to the other parts of the metropolis. Again, the last one that I will say as a factor would be design and architecture. If you're going to be looking at the design of Empress and Galleon in Ortigas Center and Capitol Commons, you will see that it's going to be comparable with first world type of developments. And that's the reason why they can actually withstand the test of time. It's almost like you're buying Singapore, you're buying Manhattan 30 years ago, 20 years ago. You know, I get to ask a lot of people that if you were given a time capsule and you can be taken back to 20 years ago, and 20 years ago, you would be given the opportunity to buy in like a Makati, an Ortigas Center, okay? Would you buy? Of course you would, right? Knowing that, you know, these things would have transpired in the last 2 decades and the prices are going to be very different, you would. But you see, many people are faced with that dilemma. We always say, okay, in a crisis, you know, I'll probably buy. When the crisis comes, we don't. And after the crisis, we'll often say, sayang, I could have bought. But again, execution is the important thing here. What are you going to be doing? See, when you look at wealth management, there are only 2 ultimate objectives: fulfilled lives and sustainable legacy. Fulfilled lives and sustainable legacy, taking care of ourselves today and taking care of our loved ones in the future. How responsibly have we done that? If we're going to be looking at the instruments that are out there, the vehicles that are out there, property would be one of the best to deal with and connect with these 2 ultimate objectives on a sustainable basis. Then that's very, very important. So if we are into real wealth management, we'll have to consider certain investments that address our real objectives. And on top of that, out of those instruments, we'll have to choose the ones that are within that area where success is going to be far, far better than others. In terms of chances for success, we have to look at the names, as we're saying, the brands that we have to look forward to, that we can see, not just protecting our values, but increasing our values and connecting us to growth moving forward. In making those business decisions, I always end with this line. I always tell people, always anchor everything on what truly matters. And sometimes, we get fixated with earning money. We get fixated with expanding portfolios. Maybe the question that we get to ask ourselves, or we should be able to ask ourselves, is why? For who? Because when you're answering those questions, you will change the way you view the markets. You will change the way you view your opportunities. And you will also change the way you view vehicles that you put into your portfolio. And again, we all know, we have friends who have been so entrenched with property, and their families have always been blessed over the decades because of that decision as a family. And I think you all know we should be following suit. And this is such a great opportunity for us to be able to do it. The deals are on the table. It is up to you to be able to execute and make things happen. Again, ladies and gentlemen, good morning. Thank you once again for making us a part of your Saturday. And I'm open now to answering questions, but I know we have a little break. So again, I give the floor back to Paulina. Paulina, thank you so much.
All right, thank you so much, Mr. Rex Mendoza. So I'm sure what you shared with us helped our viewers a lot this morning. But for everyone who's watching us, we will take a 5-minute break before we proceed with the Q&A portion. Thank you.
Welcome aboard the Galleon, a vessel built to awaken your passion and purpose. It has everything you need on board. But most importantly, it is a home. But what makes a place your home? A home is where you become the best version of yourself, being in control and living your dream. A home is for strengthening your core and invigorating your spirit so you can take on the world. Day by day, a home is made for morning rituals. Looking forward to your journey ahead and getting ready for what the world has to offer. Together, going further. A home is for indulging in a life of luxury, being surrounded by elegance, living in opulence, the finer things in life. A home is where you can unwind after a tiring day in the city, to refresh and savor the little moments. Welcome to your new home. The Galleon is a premier 2-tower development by Ortigas Land. The first tower, Offices at the Galleon, is a Grade A office tower for sale, built on top of a 2-level retail podium. The second tower, Residences at the Galleon, is a luxury residential condominium that complements its prime location. Anchored at the heart of the Ortigas Center, it is one of the most accessible places in Metro Manila, surrounded by well-known schools, hospitals, and shopping malls. Residences at the Galleon is a 51-story tower designed for modern urban dwellers. Each unit is built with the finest materials, with a touch of modern, mindful architecture. Feel right at home as the grand lobby welcomes you to your living space. Take a dip in the pool or walk along the outdoor garden to clear your mind. Win friendly competitions in the game room or sit back for a movie night in the theater room. Grow young minds in the daycare and celebrate big days in the social hall. You can choose from 1-bedroom, 2-bedroom, or penthouse suites. Be in control with just one click using the Galleon smart home system. And live in an eco-friendly development. With everything you need at bay, we are redefining the joy of urban living. Whether you are thriving independently, a newlywed couple, or a growing family, we have designed a home that adapts to your changing lifestyle. So come aboard, take control of your own journey, and steer it in the right direction with Residences at the Galleon.
Okay, so welcome back. To moderate our Q&A portion, I would like to introduce Ortigas Land's AVP and Head of Sales, Ms. Rose Morales.
Hi, good morning, everyone. Good morning. Thank you for that introduction. So I'm sure a lot of our audience this morning learned a lot from that very informative and insightful discussion of Mr. Rex Mendoza, one of the most sought after both online and offline investment speaker today. So I think I'm ready to shoot the first question for Rex. So we see a lot of questions coming in from our Facebook and from Zoom. So maybe the first question that I will ask, because Mr. Rex Mendoza mentioned about strategic investing. So for a typical young professional starting their strategic investment plan, what would you recommend should be the ideal share of the real estate portfolio into their plan?
Okay, I'm not exactly familiar with what he probably will have in this basket, Rose. I guess the real suggestion that I have, especially for someone starting up, would be a minimum of 30%. So basically, how much he has spent or how much he has set aside would be a function of how much he can commit. But at this particular day and age, I think it will be up to him to come up with something that can be a flow commitment coming out of his earnings, and then 30% base will be good enough to maybe start with like one property to be able to have what we call a hard asset. Many millennials actually are so into very liquid assets. I mean, they're into marketable securities. They're even into non-tangibles like Bitcoin. That kind of worries me a lot because these are not time-tested investments. And while they say it's their new world, it always pays to take account of the old world. And that old world in terms of property investing has gone back centuries, right? We all know that, centuries. So I would probably blend it. So 30% for me will be a minimum.
All right, thank you very much for that answer. So we have a lot of young professionals listening to us right now, and I'm sure that they will, really think about your advice. And we saw a lot of professionals already investing early on into a property, and that's very good. All right, so I move on to the next question. So what do you think will be the potential impact of COVID to condominium development selling versus horizontal development?
There's this view because of COVID, I guess people are kind of like locked up into their homes. It's almost like they want to go out. And because you're in a condominium, you're almost like cramped. And then people are looking forward to have that backyard, that place where they can frolic under the sun and still be within their property. So that's a good trend. That's a good realization. But again, Rose, the message I have for a lot of people will often be this, that you have to understand and remember, much like all the crises in the past, this too will be over. This too will come to pass. And after it happens, people will realize, will you trade off that backyard for being close to the place of work? Will you trade off that backyard to be conveniently located at the center of everything, where you can be within a mall, within a congregation place? So we always go back to who we are. I always mention this. I'm a marketing practitioner as well. deep in my heart that always comes out. The fact that we're social animals, we're always going to be guided by human nature. And human nature will tell you, eventually, all of these things, after they come to pass, will probably change certain things that we do, but most of it will remain the same. So I agree, people are going to be looking for houses and lots today, but I am of this notion that people who are buying houses and lots, who would like to live in houses and lots, that's going to be fine. I mean, there are people who are going to be like that. But this trend that you're saying, for the people who are in condos who want to move there, that's for me temporary. Once it opens, you'll see. Right now, the traffic is bad. The traffic is back. And if you notice that, I mean, hindi pa nga bukas, bad na. So what will we expect if things normalize? People will always go back to their condos and say, the 3-hour traffic drive will not be worth it.
All right. Thank you very much. So we now move on to our next question. Okay, this is a question from Facebook. Will there be any indirect effect, if any, to the real estate sector, the record high debt of the Philippine government?
Okay. The record high debt of the Philippine government can be inflationary because we're going to be looking at the stimulus. The stimulus is probably one of the biggest the government has since time immemorial. I mean, it is the biggest that we've come up with. And obviously the question mark, how will the government pay for that? Unlike the US can actually print money. We cannot excessively do that. It's going to be too inflationary. It's not going to be sound. So what do? We borrow. The borrowing is going to be inflationary as well. That's going to be for the government to look at. Real estate will be impacted more by its own non-performing loans rather than government loans. Those I'm not going to directly correlate. In fact, if I'm going to be correlating it, there's even a positive for property. Why? Because what the government is doing can be inflationary. And when it's inflationary, you have to hold an asset that can be inflation hedged. And inflation hedge assets are only hard assets, which boils down to what? Gold, silver, property. So for us, we're not going to be too, security conscious, or those of us who are not into the actual bullion market, and I don't think there are a lot, right? Obviously, the choice is property. So that's even going to impact real property in a very positive way. However, there's a negative impact only on the NPLs, the non-performing loan risk that's higher within the industry, and that's not government related either.
All right, thank you. So I move on to the next question, and now this is also from Zoom. You mentioned some 3 drivers into our economy being OFW remittance and consumption. What do you think would be the outlook of the BPO industry moving forward?
Okay, the 3 pillars, just to clarify, the big pillars before COVID were 1, OFW remittances, BPOs, and the last one would be tourism. I mentioned that the 2 are hard hit. The 2 that are hard hit would be OFWs and tourism. Obviously, there's no one, we cannot accept travelers, we ourselves, even local tourism is probably too inactive. OFWs, they're coming back, they're losing jobs. So BPOs would be the remaining silver lining for property, especially for office. And if you're going to take a look at it, it's actually growing. I was just with the people in the forefront of our BPO industry. It's growing. Why? Because companies all over the world will have to continue lowering their costs because of their hard-hit margins. And as we do that, they're going to be farming out. People were thinking, companies will retain the jobs in the US. Companies like in Japan will try to retain the jobs in Japan. Or companies in China will retain the jobs in China. Not true. The companies, as we're talking about them, are profit-oriented. Many of them, true, can be nationalistic. But first and foremost, let me just go into a straight discussion, because I was just I was just into a conversation, as I've said, with one of the BPO stalwarts. And he said, this big company thought about doing their expansion in the US, only to find out, number one, people in the US are not good for BPOs. You know, they're hard-headed, they're hot-headed, and they're not going to be good in terms of, you know, being empathetic with clients. Number two, it's so expensive to do it there. You know, the real property, the rentals, still expensive. So if they're really going to look at their own survival, if they're going to be looking at their own trajectory, they will often look at cost reduction, and cost reduction to equates to more Philippine involvement for the BPOs. As we speak, there are deals being done in many of the offices, and that's why office inventory is low. Rose, very important, and that's why Galleon, the building that we have that's going to be office, is going to be one of the few that will be. You know, some people put the offices in the back burner, only to find out today there have been lots of interest in offices, but the supply is not going to be around. The supply is not going to be around, and the BPOs are still growing.
Okay, so I think that's very good news. So we will still see BPO to be growing and still a growing demand for offices given this pandemic because of social distance and everything. So, all right. So thank you, sir, for that answer. And then maybe we can move on to another question. All right. So the Philippines has seen a lot of crisis over the past maybe 20 years. So we saw the 1997 financial crisis, and there was another crisis in 2008. Not to mention, maybe a long time ago, there was the Ninoy assassination that brought us into really an economic slowdown. So with this COVID pandemic, how do you think, I mean, how fast do you think can we be able to recover as compared to the past crisis in the past?
Okay, I've actually done a study where I've compared those past crises. No, the one that really took long was 1997. 1997 was long because of several factors. Number one, the problem was, you know, you had a banking industry that was not well capitalized. There was no risk management. They were lending excessively without risk management. Then the problem was people bought properties that they wanted to flip. So when the drop happened, the crash happened, it was more of a structural approach. The banks will have to be capitalized. We had to have the government cover for many of them, a bit of bailouts here and there. But what has happened while we were recovering, I think we all know, I mean, I want to be apolitical about all this, but we elected ERAP to be the president in 1998. So again, while we were restructuring, that was put on hold. You know, we all know Ramos was a very good reform-oriented president, but ERAP wasn't. So that kind of, you know, extended until probably ERAP got out of power. We went back to the structural reform. 2008 was very different. 2008 was a crisis precipitated by the U.S. real estate bubble, by the U.S. subprime market. So it was global and it affected the Philippines, but we were a lot stronger because we learned the lesson earlier in 1997. So that was a V-shaped recovery. That was a V-shaped recovery. We recovered faster than the US, even EU. And in fact, we just didn't recover. We flew after that. Now, today, I'm not going to say we're going to be having a V. My own personal opinion is it's going to be a U. And we're seeing that. The U-shaped recovery, a little more, I mean, lengthy than little more lengthy than the 2008. However, as I say that, other countries will not have that same trajectory as ours. And our demographic variable, our domestic consumption, our local market, plus our strong fundamentals can put us at a trajectory which is faster than other countries, which puts us into a favored view. In fact, there was a study done, I think by the IFC, that the Philippines would be the top 10 countries where to invest post-COVID. So maybe if I'm going to compare it to 2008, it's not going to be as fast. But if I'm going to be comparing what happens afterwards, knowing that all the other countries are going to be at the back burner, the Philippines can take this with a huge stride. No? So we're going to be one of the top 10 countries to get the investments post-COVID. That was a given for many. So again, you for me, but a strong recovery afterwards.
All right, that's very good to hear once again. So I think we're in a better position right now compared to 1997 and in 2007 and 2008. All right, I think this is our last question. This is from Zoom. So whilst the value of units have gone up, I have not been able to sell my units and I will have funds to stay longer in Manila. What is the best way to realize my investment in this case? Okay, I'll just repeat the question. So whilst the value of the units have gone up, I have not been able to sell my units. I will have funds to stay longer in Manila. So I think this might be from an investor. What is the best way to realize my investment in this case?
Okay, I would not even to sell today. See, anything that's put on the block for sale today, people are going to be expecting a distressed price. They'd want to see that. So if you're going to be putting a property on the market with the right valuation, people are not going to notice that. You have to look as if it's a distressed sale to be able to get the attention. That said, I'm probably not going to sell. I'm going to borrow against the property because interest rates are low. So I'm just going to get the cash that I need, okay, at a low interest rate to be able to get myself into the liquidity. But I still want to own my asset. It is not the time to let go of the asset today, okay? So I will borrow against it, low interest rate, and then once this whole thing changes and recovers, that's when I put my properties on sale. So much so that my cost would have been the interest rate, which is a lot lower. Because if you sell your property today and force the issue on the price, you might lose a lot. And you're not losing a lot of value because there's a loss in value. You're losing a lot in value because you want the transaction to happen. So those are two different things. Huh? So very important for me, buy time, borrow against it, and sell it at the right moment.
All right, so thank you very much because I've been getting a lot of inquiries like for people wanting to sell right now their properties, and I guess you just answered their concerns. No, that's a very good suggestion. So they need to hold on their properties right now because in just maybe a couple of months, a few months down the road, we'll be able to recover and maybe they can borrow against it. All right, so in as much as we'd like to entertain more questions, I guess we have very limited time. So once again, Mr. Rex Mendoza would like to thank you for your time today. I personally learned a lot. Once again, it's been very exciting to hear you speak because I learn new things all the time, and I'm sure our audience also feel the same. So once again, thank you very much, Mr. Rex Mendoza. It was a pleasure sharing the limelight with you here. Thank you.
Thank you. Thank you.
All right, so again, thank you, Ms. Rose, and thank you, Sir Rex. Before we officially end this webinar, for those who are planning to upgrade their gadgets or having an Apple product right now is relevant and has become a necessity. So why not hit two birds with one stone today, right? And to show you what it looks like having an integrated lifestyle, here's a video of Capital Commons.
Live your best life at Capital Commons, a 10-hectare mixed-use development located in the heart of Ortigas Center, Pasig City, Philippines. From modern living spaces, a bustling business center, to premium retail and dining experiences, Capital Commons lets you live the high life. Imagine starting your day in exclusive residences, breathtaking views, and purposefully designed spaces for the lifestyles of today's and tomorrow's distinguished professionals. Build your ambition in estancia offices, enjoy complete shopping experiences, or lose yourself in exquisite retail choices right at your doorstep. Treat yourself to cinematic adventures in an unparalleled entertainment center. A lush oasis in the center of the metropolis. and unique gourmet adventures for every taste. Everything you need within your reach. The height of luxury living is in Capital Commons. Master. Live.
Hi, my name is Bernard Caledi of Ortigas Land, and we are here right now in one of our estates called Capital Commons. I'm standing right here in Estancia's East Wing, so we are going to show you the Empress Pop-Up Model Unit. Let's go. So Empress is a 56-story residential building, and it's a 4-tower tri-city capital complex. So here is our pop-up model unit for Empress. Empress is our first tower to feature a smart home system, and you may control your lights, aircon, and some appliances through your phone. It's the future of condo living. So imagine yourself coming home to a cool unit from your busy day. So each unit is fully fitted, meaning when we turn over the unit, it comes with overhead cabinets, base cabinets, countertops. For the bathroom, you get Hans Grohe bathroom fixtures and cooler. This actually is a 40 square meter studio unit. So our studio units are practically, they have good sizes. So we have also 1 bedroom, 2 and 3 bedroom units. The bedroom area, and you have the dining and living room space. Then when you turn over the unit to you, it comes also with closets. Then when you come out here, you have a decent sized balcony. The units on the low floor, you have a view of the amenities. So we have 2 kinds of amenities, which is the quiet zone and the active zone. So the quiet zone is actually where you can do your yoga, do some meditation, maybe read a book outdoors. And for the active zone, you have a pool and some outdoor cabanas.
Okay, so that wraps up our webinar for today. Again, we learned so much today in today's webinar thanks to our speaker, Mr. Rex Mendoza. Sir, thank you for sharing your time, knowledge, and expertise with us on this Saturday morning. And of course, to Ms. Rose for moderating our Q&A portion. And of course, to everyone who tuned in even on the weekend. Again, I am Paulina Aguilar. Thank you so much and have an awesome day ahead.